If you've been filing taxes for more than a few years, you may have begun to notice a growing amount of important documents, receipts, and tax returns that have started to pile up. Larry from Indianapolis asks, what do I need to keep and how long do I need to keep it? Watch this video to learn more.
Welcome to this episode of Accounting and Tax Tips, Smart Strategies for Small Business Success, with Certified Public Accountant Tina Moe.
Well, Larry, this is a great question I get at least once a year, and it's a good one to ask. How long do you need to keep all this stuff? What exactly do you need to keep? And let's take it a step further. Why do you need to keep it? The length of time that you should keep certain records really depends upon what that record proves. You should keep documents and receipts for any kind of income and deductions you report on a tax return until the statute of limitations runs out for that tax period. The statute of limitations refers to the amount of time that you have to amend your tax return, to either claim an additional credit or refund, or that the IRS has to assess additional tax for that tax year. Typically speaking, this statute of limitations is 3 years from the date the tax return is due or when the tax return is actually filed, whichever is later. Keep in mind, however, there are some limitations to this 3-year statute of limitations rule. For example, if you discover that you have underreported your income by more than 25% of the gross income on your tax return, the statute of limitations becomes 6 years. If the IRS determines that a tax return has been filed and it is fraudulent, or maybe you didn't file a tax return at all, there is no statute of limitations for these tax years, so you'll want to keep those records indefinitely. If you file an amended return, the statute of limitations is 3 years from the original due date or 2 years from the date you paid the tax, whichever is later. If you file a claim for a loss due to worthless securities or a bad debt, you'll want to retain those records for 7 years. So what sort of records should you keep? Individuals should keep W-2s, 1099s, and any other records that support the income claimed on the return. You'll also want to keep all of your bank statements because these are frequently requested for an IRS audit. On the deduction side, you'll want to keep your receipts and any third-party records that document a deduction that you've claimed on your tax return. You'll want to be sure to keep records pertaining to assets even after you've sold them because this generally supports the amortization, depreciation, or gain-loss calculation claimed on the return. Be sure to keep your records in a dry, safe, and fireproof location. You can keep them in their original format in paper, or you can store them electronically as the IRS typically will allow reproduced copies of records for audit purposes. And one last thought. It's important to keep these records not only for an IRS or state audit, but also in the case of a creditor dispute or an insurance claim or for lending purposes. Larry, I hope this was helpful. If you have a tax question, feel free to email it to me at tina@actservices-inc.com, and I'll make it the topic of a future show. For more information, visit my website at www.actservices-inc.com.
Thank you for watching this episode of Accounting and Tax Tips with Tina Moe. For more great information, visit Tina's website at www.actservices-inc.com. Also browse the other shows found right here at Indie Biz TV Shows.